Well, we know that businesses record transactions every minute of the day. We also know that the accounting equation is assets equal liabilities plus stockholders' equity. Those transactions affect the accounting equation each time they occur. So let's do a drill where we analyze transactions and talk about the effect they have on the accounting equation. Our company is ACG Lawn Maintenance, so we're into lawn maintenance. Our business model is to cut grass and maintain landscaping for our clients. Our customers include residential customers or homeowners and medical facilities. Our residential customers always pay us cash at the time the service is provided. Our commercial customers, on the other hand, either pay us in advance of receiving the service, or we bill them once the service is provided. We have a chart of accounts on this page. The chart of accounts lists all the account titles that we'll use when we analyze the transactions. Next to the account titles, I list their classifications. The accounts are either assets, liabilities, stockholders' equity, revenue, or expenses. The assets, liabilities, stockholders' equity, revenue, and expenses are the 5 elements of accounting. So now let's look at the 15 transactions we have and see how they affect the accounting equation for our company. The steps that I will follow are: first, we'll read the transaction, determine which accounts are involved. There will always be at least 2 accounts. Our second step will be to classify the accounts as one of the elements. They're either going to be assets, liabilities, stockholders' equity, revenues, or expenses. Then our third step will determine whether the accounts are increasing or decreasing. And then finally, we'll enter the amounts into the accounting equation. Assets must equal liabilities plus stockholders' equity for each transaction. Let's go. Let's move through these transactions. Transaction 1. Receive cash for issuing 15,000 shares of common stock to investors. $150,000. The 2 accounts involved are cash and common stock. Cash is an asset, common stock is a stockholder equity account. So when we enter the information into the accounting equation, we add $150,000 for cash assets, and we add $150,000 in stockholders equity under the column called common stock. So for this transactions, our assets have increased, and so have our stockholders equity. Transaction 2. We pay cash to purchase a computer to keep track of our business transactions, $3,500. The 2 accounts involved are cash and computers. Both accounts are assets. In the case of computers, the asset is increasing because we're buying the computer. In the case of the cash asset, the asset is decreasing because we're paying cash out. So on our accounting equation, we have $3,500 increasing and $3,500 decreasing in the asset column. We've had an asset increase and an asset decrease. Transaction 3. We purchase lawn maintenance equipment, paying 1/3 down and financing the rest with a note from the bank. The total cost was $60,000. So in this problem, we have 3 accounts. We have one account that we're going to call equipment, another account, cash, and the third account, notes payable. The equipment account is increasing, and it's increasing by $60,000 because that's the total cost of the equipment. Our cash, which is an asset, is decreasing by $20,000. And the reason for it being $20,000 is because we made a down payment of 1/3. 1/3 of $60,000 is $20,000. Notes payable, which is a liability, is increasing by $40,000. We borrowed $40,000 from the bank in order to purchase this piece of equipment. The cash paid of $20 plus the amount borrowed of $40 equals the $60,000 cost of the equipment. On our accounting equation, we're going to add an asset for $60,000 representing the equipment. We're going to subtract an asset of $20,000 representing the cash outflow for the down payment. And in the liability column, we're going to add a liability of $40,000. Now notice my accounting equation balances. I have $40,000 in assets net and $40,000 in liabilities. So my assets ultimately increase, and so did my liabilities for this transaction. Transactions 4, 5, and 6 represent what we will call prepaid expenses. A prepaid expense is an asset, so it will show up on the balance sheet. It results from a business making advance payments for goods or services to be received in the future. Prepaid expenses are always initially recorded as assets, but their value is expensed over time as they are used up. Unlike conventional expenses, where you pay them during the period, the business will receive something of value from prepaid expenses over the course of several periods of time. So let's look at the 3 prepaid transactions that we have here. Number 4, prepaid 3 years of insurance for equipment, $2,400. The 2 accounts involved are prepaid insurance, which is an asset, and cash, which is also an asset. The insurance is an asset because we're getting 3 years of coverage. It's not just the cost or expense of the current period. Anything that has value over time is an asset. In this case, the prepaid insurance asset is increasing and the cash asset is decreasing. So as we fill in our accounting equation, we have prepaid insurance, the asset going up, increasing by $2,400, and cash asset decreasing by $2,400. So we have an asset increasing and an asset decreasing. Now let's look at number 5. On number 5, it says we bought supplies to be used during the next 6 months on account. $3,000 worth of supplies were purchased. On account means we didn't pay for them at the time of purchase. On account means we owe the supply company $3,000 and we'll pay it at a later date. On account, then, is a liability because it represents an amount owed. So for this transaction, supplies is an asset. The asset is increasing. Now, supplies is an asset because it's going to be used over a 6-month period. We wouldn't want to expense it all during the current month. We want to expense it over the time we actually use it. Accounts payable is a liability. So both our assets are going up and our liabilities are going up by $3,000. We have an increase in assets, increase in liabilities. Number 6, the same thing. We rent a storage warehouse and we prepay 1-year rent, $24,000. So the rent for the entire year is $24,000. We don't want to expense it all in the current month. We want to expense it month by month over the next 12 months. So the two accounts involved are prepaid rent and cash. Prepaid rent is an asset, and it's increasing by $24,000. Cash is an asset, decreasing by $24,000. So on our accounting equation, we have our asset, prepaid rent, going up, and we have our asset, cash, decreasing. So we have an increase and a decrease in the assets. Now let's look at transactions 7, 8, and 9. In every one of those transactions, we're providing services. In one case, we're receiving payment immediately, and in the other two cases, we're receiving payment at a later time. For number 7, we've provided services for our residential customers and received payment, $10,000. The two accounts involved are cash and service revenue. Cash is an asset, and it's increasing by $10,000. Why? Because we've provided services. Our revenue is increased as well by $10,000. So on our accounting equation, we'll increase our assets because cash goes up by $10,000. We'll increase our stockholders' equity by $10,000. But more specifically, we'll put the $10,000 in retained earnings. Remember, stockholders' equity is made up of two components. Common stock, which represents what investors have put into the company, and retained earnings, which represents the earnings that the company itself has generated. The beige boxes that we have on the accounting equation represent revenues and expenses and ultimately the impact they have on net income. Revenues and expenses are elements which ultimately affect retained earnings. So in this case, the fact that we have $10,000 worth of revenue will ultimately increase the retained earnings of the company, which in turn is a part of stockholders' equity. That revenue will help generate a higher net income. So in the end, for this transaction, we have assets going up because cash is increased, and we have stockholders' equity going up because revenues increase stockholders' equity. In number 8, we provide services for Lee Medical Properties, and Lee will pay us in 30 days. $15,000 was the value of our service. The two accounts involved are accounts receivable and service revenue. Accounts receivable is an asset. Accounts receivable is an asset because it represents our right to collect $15,000 from Lee Medical Properties within the next 30 days. Service revenue is revenue in this account because we are providing the services that Lee Medical Properties owes us for. Now, when businesses deal with other businesses, they rarely collect cash. Most of the time, payment will come within 30 days or a short period of time. The business providing the service, or in our case, ACG Lawn Maintenance, treats the fact that money is owed to it as an accounts receivable. Accounts receivable then is always an asset, and it's increasing at the time we provide the service. So in our accounting equation, assets will go up because of accounts receivable. Stockholders' equity will go up, and it will go up in the column retained earnings. And again, like our last explanation, retained earnings is increasing because revenue causes retained earnings to increase. Revenue contributes to the net income of the company, and ultimately affects retained earnings. So overall, our assets have increased and our stockholders' equity have increased. Transaction number 9 is exactly like transaction 8. We provided services this time for Physicians Group Medical Properties on account, $12,000. Anytime we provide services on account, the term on account means that we aren't getting paid today, we'll get paid at a later date. So the two accounts involved are accounts receivable and service revenue. Again, accounts receivable is an asset, service revenue is a revenue. On our accounting equation, our assets will increase by $12,000 and our stockholders' equity will increase by $12,000. That $12,000 will be placed in retained earnings. Again, because revenue ultimately affects retained earnings. Revenues contribute to the net income of the company and ultimately affect retained earnings. So our assets have increased and so have our stockholders' equity. Transaction 10 will require a little bit of explanation. In this transaction, we received payment from NCH Medical Properties for services to be provided during the next 3 months. So in this case, our customer is paying us up front. We're receiving money before we've done anything for them. And the amount is $21,000. The two accounts involved in this transaction are cash and deferred revenue. By now you know that cash is an asset. If we're receiving payment, the asset is increasing. The other account involved is deferred revenue. The word deferred means to put off. So we're putting off our revenue to a later date until we've actually performed the lawn maintenance for them. We can't call something a revenue account until we've actually provided the service or done the work. The account deferred revenue is used to represent the fact that we owe NCH Medical Properties $21,000 of lawn maintenance services. No revenue is recognized at this time. It will only be recognized once we actually provide the service. So for this transaction, our assets increase and our liabilities increase. No other element is affected. So when we go to the accounting equation, our assets will increase because we received cash. Our liabilities will increase as well because we have a deferred revenue account, which is classified as a liability. That amount represents the $21,000 of service we owe NCH Medical Properties. Transactions 11 through 14 all represent expenses for our company. Sometimes people have trouble distinguishing an expense from an asset. So let's talk about these two. Now, expenses are different from assets. When we talked about assets in the prior transactions, we talked about resources available to the company that provided a future benefit for our company. Expenses, on the other hand, represent expenditures that have taken place during the operations of our business
that benefit only the current accounting period. They don't provide a benefit beyond the current accounting period in which they were incurred.
Transaction 11 says paid rent on office building for the month, $2,000. The two accounts involved are rent expense and cash. Cash is an asset, it's decreasing. Rent expense is an expense. Now it's expensed here because we're paying it during the current period, and as a result there's no future benefit to it. So the expenditure is kind of a one and done. We pay it and we're done with it. When we look at our accounting equation, our asset cash will decrease by $2,000, and our stockholders' equity will decrease by $2,000. Because unlike revenues, expenses decrease the amount of net income and ultimately affect retained earnings by decreasing. So for this transaction, we have our asset cash going down or decreasing, and stockholders' equity decreasing as well. Transaction 12 is recorded exactly the same as transaction 11. In 12, we are paying workers wages for the month, $10,000. The two accounts involved are wage expense and cash. Wage expense is an expense, and it's increasing, and cash is an asset, and it's decreasing. So now when we go to the accounting equation, our asset cash will go down or decrease by $10,000. And our stockholders' equity will go down by $10,000. We'll enter the $10,000 in the retained earnings column again because expenses cause net income to decrease. They also ultimately affect retained earnings. So our assets have gone down, and so has our stockholders' equity. Transaction 13 requires a little explanation. In 13, we received the current month's bill for utilities, but the bill is not due until the first week of next month, so we will not pay it during the current period. The two accounts involved are utility expense and accounts payable. Utility expense is recorded because it is an expense for the current period. Because we're not paying the bill at this point, we cannot use cash. We use accounts payable to represent the fact that we owe the utility company 1 month utility bill of $800.
So as we enter our information into the accounting equation for transaction 13, we increase our liabilities and we decrease our retained earnings. The increase in liabilities represents the fact that we owe the utility company $800. The decrease in stockholders' equity and ultimately retained earnings represents the fact that we have a utility expense of $800. So again, in our beige boxes, we show the expense as $800, and we show that that expense ultimately decreases our net income, which in turn decreases our retained earnings. So for transaction 13, we had an increase in a liability and a decrease in stockholders' equity. For transaction 14, we received the current month's phone bill, which is not due until next month. That bill is for $400. The two accounts involved are telephone expense and accounts payable. Telephone expense is an expense and it's increasing. Accounts payable is a liability. The reason why we're using accounts payable is because we're not paying the bill now, we're going to pay it next month. Anytime we owe someone money, in this case it would be the phone company, it's an accounts payable. So when we enter this stuff into the accounting equation, we're going to increase our liability by $400. We're going to decrease our stockholders' equity using the retained earnings column by $400 because of the phone expense. The telephone expense is an expense and as such decreases net income and also stockholders' equity. So for this transaction, assets were not affected, liabilities increased, and stockholders' equity decreased. Transaction 15 says receive payment from transaction number 9. In number 9, we provided services for Physicians Group medical properties. They didn't pay us because those services were on account. So they owe us $12,000. Because Physician Group medical property is paying us, our accounts receivable goes down. Accounts receivable is an asset. It decreases because we're receiving cash. So in this case, on our accounting equation, one asset, cash, increases, while another asset, accounts receivable, decreases. There's no other effect on the accounting equation. Now that we have analyzed all 15 transactions and identified their effect on the accounting equation, it's time to total all our columns. It's the moment of truth where we make certain that assets equal liabilities plus stockholders' equity. So let's total assets first. We add everything from transaction 1 all the way down through transaction 15. When we sum those totals, we get $239,000. We're going to do the same thing for liabilities and stockholders' equity, both the common stock and retained earnings columns. Our liabilities, when we add them up, total $65,200. Our common stock is $150,000. Our retained earnings is $23,800. So our total stockholders' equity would be the sum of the two components of common stock and retained earnings, or $150,000 plus $23,800, or $183,800. When we add the total stockholders' equity to the liabilities of $65,200, we get $239,000. Our accounting equation is in balance. Our assets of $239,000 equal our liabilities plus stockholders' equity of $239,000. So this drill gives you a good idea of how to analyze transactions and see their effect on the accounting equation. My first column showed you the transaction. The middle shows you the effect on the accounting equation. In the far right columns, identify the increase, decrease, or no effect of each of the transactions. Hope this video helps you. Good luck.